if you look at the coincident economic indicators, which I wish the Fed did, they actually look at lagging indicators. But if you look at the coincident ones, they all look quite good. GDP has a 3 handle, so forth and so on. If you look at the indicators I have historically used in my business, they're not quite red yet, but they are I'm sorry.
No, continue. They're not red yet, but what?
But they are definitely amber, and they are setting off warning signs.
What do you see?
Okay, so the best economist I know is the inside of the stock market. And I'm sure you've heard Erik the joke, and I heard it at Bowdoin in my Economics 1 class, the stock market's predicted 9 out of the last 5 recessions. I will say with all humility, that's better than the Fed. They've gone 0 for 9, so 9 out of 5 is not that terrible. But the best economist I know out there is the inside of the stock market. So the Fed, when they look at the stock market and they look at financial indicators, probably is just looking at the S&P. But the decline in the S&P, which is funny, when I was preparing for this interview, it was 10, it's now 13, is a bit of a mirage. Because if you look inside the stock market, the cyclical elements of the economy, particularly the front-end cyclicals, show a completely different picture than the defensive parts of the stock market.
The stuff that's more sensitive
to the economy. So, auto stocks are down 30%. They're not down 10 or 11, they're down 30. Building stocks are down 35. Banks, which you would think might be a symbol of credit or something else, are down 25%. The Russell 2000 is down over 20%. Retail equities are down over 20%. So how in the world could the S&P only be down 10 or 11 when I was looking at these numbers? It's because utilities, staples, and pharmaceuticals, which are economically defensive, are actually up. And this is the same situation I've used cycle after cycle. So that's one of the things. The inside of the stock market, which is the best economist I know and which I've used every cycle when I've invested, is saying there's something not right here.
And this is the same set of indicators that you've used to predict the past 4 recessions? The very same?
Yes, you might say it's because I have a not so pleasant personality, but at Duquesne, we did predict the last 4 recessions, and our returns going into them and as they started were always well above our average returns over time. So inside the stock market is one indicator. The second would be the yield curve. Again, amber, not red. But we've inverted, as you know, from 5s and 2s, just slightly. 2 years are 269, 5 years are 268. The 10 years 285. So there's not only a big flattening going on, it's a very confusing bull flattening, because it's not like we're looking at high rates to start with here, and the Fed has, told us that there's going to be 3 to 4 hikes next year after this hike, and the market is just saying, no, no, no. Then the other thing we've looked at historically is credit. Tends to lead the economy. There seems to be a confidence that this cycle we don't have the danger we had in the last cycle, because the bad stuff, a la housing back then, has not infected the banks. It was more done in the high yield loan market. And to me, it's true. It's great that it's not in the banks, because that would probably be a systemic problem and financial crisis. But the economy doesn't really care whether credit is in the banks or it's in the investment community with high yield loans. In fact, I would argue that if you're on the other side of it, you'd much rather work your loan out with a bank than you would with some hedge fund manager out there. So the fact that, I'm sure you read the article in the Financial Times yesterday, and the fact that credit is drying up to the extent that it is, and there are all sorts of warning signs there. I think the GE CDS has gone from 50 basis points to 200 basis points since September 1st. IBM's gone from 30 to 80. High yield indexes are moving. Leveraged loans are down 3%. But more importantly, because we've had 8 years of free money and the kind of excesses and pushing people out on the yield curves that's created, it's just a time for caution that you want this bubble to unwind slowly now, because if you don't, and let's say these indicators turn red, you may have to do a lot more crazy monetary stuff, and actually it'll be more of a problem.